Hello everyone and welcome to my October portfolio review. I'm going to take you through the full performance of my stock portfolio. This is part of my monthly series and I use it to hold myself to account by being able to share with you transparently every month what I've been up to, what's in my portfolio. I've got a very long-term investor goal to hit £1 million, ideally no later than 2050. So this is my way of keeping myself on track, holding myself to account, sharing what I'm up to. Hopefully you'll find it useful and interesting, particularly if you've got a long-term investing goal or a target that you'd like to reach. None of it's financial advice, it's just what I'm doing myself. Yeah, let's see how I've got on in October in terms of my long-term investing goal. Let's dive straight into the screen. The detail for you today, I'm going to first of all show you the value in my portfolio and how I'm doing on the run rate. I find the run rate important. It tells me the rate of return I need from all my investments from today going forward to hit my target. I'll then take you through the dividends I received in October, followed by thirdly, all of the transactions. That'll then lead to the overall portfolio structure. And then finally, all of the holdings and the performance of all of those holdings. So as a reminder, for the end of September, I was at 38,844. I'm now at 41,117, so a very large increase in the month of October. So despite the stock market crash, the performance is up almost £2,000 a month, and I've also added a minimum £300 deposit in October as well. And to hit the 2050 stretch targets, I need to be at 38,500 by the end of this year, and I'm at 41,000 now. With another £600 to come plus dividends, if the performance stayed the same, I'll be looking at about 42,000-ish by the end of the year. So there's a good chance I'll be ahead of the stretch target at this very early stage. Now, the required run rate, this is key. I can't stress this enough. I think it's very important for anyone who is investing. This is why I do it. This is my check to myself based on my current value and the amount of time left and the minimum amount of money I'm going to put in. How much do I need to turn, compound annual growth rate, hit the target by those two milestones? So the dividends, around about £60 of dividends in October, and a third of that came from K3 Capital Group, which is a UK small cap company. That goes okay. One of my favourite investments was around about £15, so that was about a quarter. Then Alphametic Electrical Resources, the coal company, and then you can see a few others there listed on the screen. So a relatively quiet amount of dividends, but it's good to track those. I do include dividend values in my total return performance figures that I'll show later in the presentation. So sells in October. Now these are two positions, Boohoo and Hooyah, that I've been wanting to get rid of out of the portfolio for two reasons. Well, I had Hooyah on the sell list before, and I sold that out. Looked into the company again. Compared to the story when I bought it, it wasn't the best buy anyway to start with. It's materially degraded. And then Boohoo, looking at the most recent results, what's going on, rather than just sitting there watching it, I've taken the bullet and taken the big loss. I'm well above the run rate in my portfolio. I'm ahead of the target. Position for Boohoo is a lot worse than it was. I'd rather use that money in higher quality companies, as we'll see coming up. So those two are sold. Boohoo, in pounds terms, my worst ever stock holding. I know some of you watch this channel do own Boohoo, so I'd be interested to hear, are you averaging in? Are you buying more? Are you holding? Or have you sold out and cut your losses? I've sold out because it doesn't meet my strategy, and the view of the company for me has degraded since the initial purchasing in terms of margins, in terms of return on capital. Debt's gone up. That's done it for me. On the buy side, I've added a bit more into the Fundsmith Equity Fund. I think about £250. We'll be adding more to that every month. And I've added a very small amount to Alibaba when it got down to that 60 range. It's a very good company. I think at that level, it was just too cheap to ignore. Overall, not very much money committed at all on the buy side. On quite a large cash pile at the moment. And here it is. So this is the split of my portfolio. So with my portfolio, the cyclicals, we'll go through all of the details in each of these sections shortly, but cyclicals is about 10% of the portfolio. I don't want it to be any more than 10% of the portfolio. Ideally, what I'm looking for is dividend stocks to be around about a quarter. Managed positions, protection against my failure and ignorance, to be around about a quarter. Quality stocks that make up to 50%. And then there'll be a flex of anywhere between 0 and 10% on cyclicals, depending on if there's opportunities, those rare opportunities. So compared to my now target strategy, I need more money in quality companies and a little bit more in the managed pot, but there's no rush. Looking at that percentage split, you can see I'm 7,000 in cash, as 17%. That's probably higher than I'd like, particularly as that doesn't earn any return. I want to look to deploy that. I'm not in a rush, but I want to make sure anything I buy, particularly new positions as well, do fit in with the cyclical, dividend, quality or managed categories, how I've defined them. I do note the unclassified section, almost 10% of the value of the portfolio. These are companies that don't fall into those top 4 categories. I want my portfolio to be going forward. But most of them are kind of decent or good companies. They're just not very high quality companies. They're just good. Don't fit into one of those 4 labels. So I'm trying to work out what to do with them. I'm not going to sell them for the sake of them. Alibaba, for example, because I do think there is money to be made there. So performance of the cyclicals, we're going to look at AMR, Alpha Metallurgical Resources. By far and away the biggest holding in this section. I'm up almost 350% on that total. And that is up 25 percentage points from the start to the end of October. And Ramaco Resources, also very good, up 51 percentage points over the month. So both of these are met coal producers, but some of that met coal is actually used for thermal purposes due to the current sort of energy crisis, let's call it. None of the other holdings here are significant, but Argo Blockchain just looks like a waste of time, really, at that amount of raw pounds. Lots of dividend stocks, but the star performer, Unum Group, I put about 1,100 quid into this, and it's now worth 2,700 in over 2 years. Total return of 157%, including dividends, and it's up 32 points a month. So I think it's about $46 a share or so as for the end of October. Really happy with that. You know, it's the company in this list that I put the most into, and it's got essentially the second best performance. Investec's also done really well, up 51 points a month, so that's 219% return on that one. In fact, if you look at this dividend list, what it's fair to say, at least at this stage, based on the total return, they're all positive apart from Walgreens, which is only marginally down. So it seems to be quite good, considering how most of these, I think all of these for a maximum of 2.5 years. 2.5 years, I've got all of those positive total returns there. We're in quite a choppy, volatile market as well. So I'm very happy with my approach for picking dividend stocks. The total returns I've got in this period of time. Now the quality stocks, well, I want to get more money in this section. Bank OZK, my favourite company in this list, is indeed the largest. That's gone past the 100% total return in month, 12 points up, now 105%. As has Anthem, which I think was called Elevance Health now. That's now up 29 percentage points a month, so 101% total return. So 2 of these have smashed through that 100% return this month, which is great. Again, look at the quality companies. Almost all of these are up to a significant amount. There's a few that are down a little bit, so Micron and Adobe, Somero, but that's just over 10%, so that's nothing significant at all. The only one that's down any significant amount is Intel, minus 37%, and that is because I entered at too high a price. Probably worth calling out on this list. The other one is K3 Capital Group, which paid that dividend. That's also up 23 points, so that one is doing well. But apart from Unilever, which I've held since 2014, I think, all the rest of these positions are under 2.5 years old. On to the managed, so this is my sort of safety protection net. Again, looks pretty positive, and as you'd expect, change in month isn't that big. You're not going to get a huge amount of volatility in indexes or managed funds. So just 2 in the 2 sell pot, but Voyager is bust, so just GAN really. I need to have a think about when to sell that. Certainly I want to get rid of that company. It's a growth stock, it's not possible. I don't want companies like that in my portfolio. That's not to say people can't make money from it. I don't want that in my investing strategy going forward. That's it. Then your unclassified, so a mixture of interesting companies here. Alibaba, which I think is a good company, and down just over half on that, but I am very confident that I'll make all that money back and some in due course given time. Same with Corsair Gaming, on the basis that it's a market leader in several fields and produces high quality products. But they just had some decent results released, so I think the stock position is looking better than it was when this data was pulled. So there's the update. We've seen the value of the portfolio, it's going well, run rates coming down, dividends been fine this month. Not a huge amount of activity, but the portfolio has less positions two less positions than it did the month before. So it's consolidating my portfolio, making it easier to manage, being able to sleep at night more easily. The structure isn't quite there, but it's getting towards it. I still need more money in the quality companies. And then the performance has been generally good in October. Now, I've talked a lot about high quality companies and Terry Smith. If you're interested to find out more, check this link out coming up on screen now. And this will really explain, get to the meat of why I think Terry Smith's investment approach is very interesting and what his 3 key steps are, his 3 steps to heaven. Check it out. You'll enjoy it.